Welcome back. One of the big Canadian corporate stories of the day is bank earnings again today. Both Bank of Montreal and National Bank of Canada early this morning reported fiscal second quarter results. Both of them exceeded earnings expectations. Let's bring in an expert to talk about it. Rob Wessel is managing partner at Hamilton ETFs and a former Bay Street Bank analyst. Rob, thanks a lot for coming in today.
Thanks for having me.
Why don't we start with Bank of Montreal? What did you see there?
Yeah, so Bank of Montreal had a good quarter, as almost all the banks did. I think one of the more important things with Bank of Montreal and the focus of the market is what's the credit trends in Bank of the West? So they made the largest acquisition in Canadian bank history.
Right.
And so last year, they had very, very elevated loan losses, primarily because of that subsidiary. So I think the market's very focused on what are the credit trends for that and where can credit normalization be. So I think getting that out of the way, they showed some meaningful improvement there, number one. Right. And so then you had, what's going on with the rest of the bank. And the rest of the bank, did pretty well. They had, stable credit. They had, very strong capital markets. Everybody is, one of the things I know we'll talk about at the end, they had a big increase in performing allowances, right, which I think the market definitely is looking for in order to get some sort of conservatism so they can feel better given the economic environment and the economic uncertainty. Mm-hmm. And, the rest of the bank's operating segments did just fine. On
Bank of the West, what does the market want to see the BMO do with Bank of the West's credit? When a bank acquires another bank, they get the loan book, they get the bad loans as well as the good loans, correct? Yeah. And so Bank of Montreal is expected now to work with those bad loans. Yeah, so I think the challenge was they ended up with a lot more bad loans than they had expected. So last year, you had a very significant increase in loan losses. Okay, fine. So is that the new normal, or do I have a lot of credit leverage on the back end? So I think if you look, Bank of Montreal's forecast earnings per share growth is quite a bit higher than its peers, in part because the function of its starting point is very elevated loan losses. And so the market, I think, is laser focused on, am I as the investor going to get credit leverage and improved earnings per share as this subsidiary starts to do better? And I think, there was a promising quarter today. Right. Otherwise, how is Bank of Montreal doing in the United States? It for many years has had operations in Chicago and the U.S. Midwest.
Well, this is, we have to go back to 1991 or get thereabouts, but I think it's done fine. I think, obviously they bought M&I during the global financial crisis. They scaled up in the Midwest, but going out and doing this huge acquisition in the U.S. Southwest, hasn't quite worked out, I'm sure, as they would have hoped. So now the question is, can they get this in shape so it matches the operating performance of the rest of the U.S. operations, which are largely in, Illinois, Wisconsin, and Minnesota.
Okay. National Bank of Canada exceeded earnings per share expectations by a wide margin, and the stock has taken off today.
Yeah, again, another bank with a large idiosyncratic issue affecting its valuation. In this instance, the integration of Canadian Western Bank.
Right.
So after they acquired Canadian Western Bank, National, which traded at a large valuation premium for quite a long time, lost that premium for a bunch of reasons, but in part because of the risk of CWB. So now, the acquisition is closed, and, they are well on their way, or they appear to be making great progress on that integration. And I think if you own National Bank and you want to say, okay, well, can I get back to that premium, which was supported by higher EPS growth and a very large ROE premium, I think you got a lot of good news today. And then, just like BMO, on the other side, very strong capital markets, which for National Bank is a very significant core competency. And then you had stable credit on the impaired side. And then again, the rest of the operating divisions did just fine. And so,
what was the good news with respect to Canadian Western Bank? Was there a surprise in the results?
No surprise. Right. I don't think. I mean, not a surprise to us anyways. I think what you saw is they gave you clear, okay, here's what our forecast synergies were. I want to say $275 million, but don't hold me to that.
Okay.
And I think there were 40%, annualized on the way through. So, that's a pretty good number. And so I think as long as the key for National Bank to get back its premium, which would support higher returns, is can this integration go on track? Can it do so without ROE dilution? And National Bank has a much, much higher ROE than its peers. So its normalized ROE was 15%. The other banks have been in and around 10. So, and now they're starting to get that premium back. It's not fully returned, but that's supporting, the big performance today.
One interpretation I heard way back when National Bank announced its acquisition of Canadian Western Bank is that National Bank is a better operator than CWB was. And so some portfolio managers were saying, we like this acquisition because we think National will do a better job of running CWB than CWB did.
Yeah, I mean, so there's a lot of really smart people at National Bank. Let's face it, it's been a very, very well-run bank for a very long period of time. So I think, that sentiment is well placed.
Okay. What are your takeaways from what we've seen so far with bank earnings season more than halfway done now?
Yeah, so I think it's a surprisingly good quarter. When you think of the economic environment and all the economic uncertainty, for example, GDP growth is still mediocre, unemployment is rising, it's perking up. So to come into the quarter and see, what was very stable impaired loan losses, so credit on loans that are, that go bad, was pretty stable. Having big reserve builds, which were facilitated by a very significant increase in trading and capital markets. And then, you have big allowances. And I think, the market is justifiably happy or relieved, I would assume, with what has been, fairly stable operating results because the economic environment really isn't all that great.
Yeah. When banks take provisions on performing loans, and a lot is being made of that this quarter, so they're provisioning for loans that are not yet delinquent.
Correct.
Does that raise the possibility in the minds of investors that at some point in the future, some of those provisions may be moved out and back into profit?
Yeah, well, I mean, this is new accounting. I mean, it's 5 years old, or give or take. I would say that that's mostly true. But the quantum or the size of these performing allowances for the whole group are so big, I think the expectation is that once we figure out, what's the impact of some of these trade tensions and things like that, my guess is that what you will see and the market will hope for is these starting to get released and coming back onto the balance sheet, building back capital, which the banks can use to deploy, and also it would support higher EPS growth. Unfortunately, I think you were hoping pre, quote unquote, Liberation Day and trade issues. My guess is, or my expectation would have been the market would have thought, we're going to get some credit leverage this year. That's going to support higher EPS growth and higher capital generation. And even if the economic environment isn't all that great, these are still positive results. Right now it feels like maybe that's getting pushed out 2 to 3 quarters, and that maybe the credit leverage that people are hoping for is next year.
Rob, thanks a lot for joining us.
Thanks for having me.
Rob Wessel is a managing partner at Hamilton ETFs. He's also a former Bay Street Bank analyst.